Everyone, Ariane here. So we love our vertical spreads. They've been a great strategy in our options tool belt. And we're going to discuss a different type of a credit spread called the broken wing butterfly. Now we're skipping over the regular butterfly because the broken wing butterfly can be constructed as a credit spread, meaning we're not paying a debit to enter it. And so I'll go over that, and the first half of this video I will just discuss the mechanics of the spread, and in the second half of the video I will go over our strategy and a couple of live trades. Let's recap what we know about the vertical spread, because I think that that will help you understand the butterfly a little bit better. So we know that in a vertical spread we are selling an option and then buying a further out of the money option. And as a result, we are opening this spread for a credit. So we are sellers and we receive a credit for opening the position. Of course, you can do this on the call side where you're selling a call and then buying a further out of the money call. And as a result, you receive a credit for doing so. And I just want you to visualize what the relationship is of these strikes to the at the money strikes. In the butterfly, you still have that vertical spread there. And now we're going to sell another strike in the middle and buy a closer to the money strike. So as a result, this is what it looks like. It's buying one option that's close to the money, selling two of the same strikes in the middle, and then buying one that's further away from the money. Now, in this example, I've skipped one strike. I skipped the 30-50 strike and bought the 30-45, but you can skip, and sometimes we'll skip two strikes and then buy the 30-40. So when we do this, we're buying for a credit, okay? So we're not sellers of the spread, we are buyers. Also, I just wanted to notate the ratio here. A butterfly will always be a 1-to-1 ratio. So if you wanted to do two butterflies, it would be 2-4-2, three butterflies, 3-6-3, etc. If you use the Thinkorswim platform, this is how you'll enter the trade. You just head to the trade tab, type in your ticker, choose the expiration date, then scroll down and find the strike that you will be going short, and just right click it, tap buy, and then butterfly. And by default, you will see that the wings are equally distant from each other. So find the further away from the money wing and then skip one or two strikes. And doing so should give you a credit here. And so yes, you would send the order with a negative sign in the front of the price. And of course, if you wanted to sell more than one butterfly, this is where you increase them. And on the call side is the same. So buy, butterfly, find the further away from the money strike, and skip. Oops. Try that again. 31.55. So you'd go down to 31.60 or 31.65 and find that credit. If you are a member of our room, we post these in a copy and paste format, so you should be able to highlight the trade, right click, copy, come back over to your trade tab, find this little clipboard, tap it, and it should enter the strikes in there as we've entered them with the whatever limit price that we had set. I noticed that for some reason this posted a -1 in the middle. To change that, just hit custom. I'm not sure why that did that. And then make sure that the ratio is 1-to-1. So you should always be short 2 in the middle. That's how you do that. Okay, like vertical credit spreads, these have a similar market direction assumption. So when you are bullish, you buy a put broken wing butterfly. When you are bearish, you put on a call broken wing butterfly. Okay, I'm putting an example up here in the top right of what an order would look like for a put broken wing butterfly. And I'm going to lay out what the ideal scenario would be at expiration. Now, I say ideal because this is what's most probable to happen, but not exactly the max profit either. So if you put on this trade in Thinkorswim and you took in $1 credit for it, ideally, all strikes will expire worthless, and you simply keep the $100. Okay, so this is what it looks like on an option chain. There's your 3 strikes highlighted in yellow. So long as SPX in this case closes above 30.65 and all your strikes expire worthless, you simply keep the $100. Let's talk about the best scenario at expiration. So this would be your max profit. If you're looking at this order, a close between 60 and 65, the higher of your 2 strikes in a put broken wing butterfly would be your max profit. So this is what it would look like on the option chain. A close right between 60 and 65. So in this example, your 30.45 and 30.60 would expire worthless. You would keep the $100 that you received at open and the value of the 30.65 put that is now in the money. So this is obviously difficult because you have to pin the closing price. And this is what your worst scenario would look like, your max loss. So a close below 30.45, your lowest strike in that butterfly, would mean that all your strikes end up in the money and you have your max loss. You'll have to ignore the colors of the option chain here. I was just trying to visualize what all of your strikes would look like in the money. Okay, I'm not sure if it helps to look at it this way, and maybe this is something that you can screenshot. So if you were to enter a put broken wing butterfly, you can simply look at it like, if it closes above my highest strike, I keep the credit received. If it closes in between my closer to the money strikes, I make my max profit, etc. And I made the same sort of screenshotable layout for a call spread because it's the opposite. Now, to calculate the margin requirement, you're going to take the width of the wider wing and you'll minus the credit, and that's how much capital your broker will require from you to put on the trade. So the more that you break the wing, the more capital it's going to require from you, but of course that's more credit you can take in. And then your break even is calculated by taking your short strike, those ones that you sold in the middle, and minusing the credit. Okay, and if you're in Thinkorswim, if you just print or screenshot the order confirmation dialog before you submit your order, all the calculations will be there. You'll see your break even, max profit, max loss, and your buying power effect, which is how much capital you need to put on the trade. Okay, I didn't discuss earlier that a close between your wider strikes at expiration would result in basically slightly less than your max loss. So I put it up here, but you'll have to know what your break even is, and you'll lose $100 for every point past your break even point. Okay, all of the previous scenarios describe the profit or loss situation at expiration. Now, at expiration means actually holding the broken wing butterfly until the market has closed. So our strategy will involve entering the broken wing butterfly on the day of expiration and not necessarily holding all the way until the market's closed. So we're going to look to exit whenever we have a profit. And we'll look to enter when we're at the high of day and put on a call broken wing butterfly or a put broken wing butterfly at the low of day. A couple things to keep in mind. When you enter the spread for a credit, you don't have any risk to one side. So your trade is purely directional and you're looking for that bonus when you pin the close price. But you still have to be right about the direction. I don't want you to think that just because you're opening the trade for a credit, that doesn't mean that you can lose money. You still need SPX to trade in your direction, and it still needs to stay above your highest strike if you're in a put or your lowest strike if you're in a call. So your trade will not be green until it does that. And also, since we're putting these on a 0 days till expiration, your profit zone is really dependent on decay. So you won't see it go green until either the last 30 minutes of the trading day or that there has been that much volatility where SPX has moved in favor of your butterfly and the premium prices have decayed. I'm going to use Thinkorswim's on demand feature and kind of go over our most recent trade. So I'm going to copy the trade from Friday, June 5th and kind of hopefully help you understand what this looks like when we're in a live trade. So I've set the on demand to, I think, about 10 minutes before Rick entered this trade. And I think I guess, give you my opinion of why maybe he entered this trade. So we're a couple hours into the trading day. I'm sorry, on the bottom it's Pacific time, but on the top it's Eastern time. So here's where SPX is trading. And as you can see, excuse me, we're approaching high of day, or we're here now at high of day, and sort of expecting a reversal, right? So it to pull back and trend down. We come over to the trade tab, and I've already copied it from the Discord room, and I'm hitting the little paste clipboard here. And here's the strikes, 3,200, 3,205, 3,220 on the call side, right? So we're a little bit out of the money right now, but I believe when he entered the trade, the 3,200 was in the money, okay? So I'm just gonna set the trade now so that it fills when it hits his fill price, which was $2. So this is what your order should look like, right? Here's the negative credit, 1-to-1 ratio. I'm not sure how many butterflies he entered, but I'm just going to use one for this purpose. Hit confirm and send it, come over to the monitor tab, and we can kind of see it working here. And we'll go back to the chart and kind of watch it. So let me fast forward this a little bit. We can kind of see here's it's pre-buffering, so give on demand a second to catch up with the data. So our order has filled, and it filled higher than what I entered it for. That's just because it's this on demand feature. Anyways, actually, I think a couple of our members did fill higher than the alerted price, which was $2, which is fine, of course. And we'll kind of watch it to see how it moves throughout this trading day of Friday. So, of course, we're bearish, right? So we want SPX to stay down, but not too far down, because we want it to kind of expire somewhere in between here. So if we closed right now where these positions are, it would be perfect, right? Because these two would expire worthless, and we would simply keep the value of this one strike. So it would be $500 plus the $295 that we took in. Of course, it's not there yet because the premiums have not decayed enough. So let's just go back to the chart. But you can see that your position is profitable now because there's been enough decay there, and we're still trading, in this range right here. Okay, I'm going to fast forward to closer to when we exited the trade, which was about 3 o'clock Eastern. So let's go there, let it buffer. And you can see that this is about where we entered right before it reached high day. That's when we got bearish, and it continued to go down a little bit and then trade sideways, which was fine for us. So this is a few minutes before we exited. Let me let this catch up a second. Okay, so now it's caught up, and we're here trading at 3,200, and you can see that now the profit is pretty close to our credit price, what we took in, and that's because that these contracts have decayed enough. You can look in here on the option chain and kind of visualize where your positions are going. Okay, and so Rick was now looking to exit the trade. One, because it's profitable, and because since we were bearish and this was Friday and there was a potential for a volatile spike up, we didn't want our higher strikes to get challenged. So we just looked to exit at this time. So to exit the trade, if I hadn't gone over this earlier in the video, you're going to hit right click, create closing order, tap the first one to sell, and then what we ended up closing it for was 15 cents. So I'm just going to enter it like that. Hit confirm and send. It filled right away. So as you can see, that's what we ended up closing it for. I think at 3:01 is when we actually exited this account or this trade, because we didn't want to be in the trade for that last 30 minutes and the potential for the spike up. So yeah, that's what that trade looked like during the day. Decay really helps these butterflies, and hopefully that helped. I'm going to recreate that last trade and kind of show you what would happen had we not exited and let all the contracts expire worthless. So I'm back to in the morning, a few minutes before we alerted the trade. I'm going to paste the exact trade here. Oops. I'm going to highlight, right click, copy, paste the trade. We're looking to enter for $2. Hit send. I might fast forward the video here until this order fills so that I can show you what it filled at and then what it looks like when it expires worthless. So I filled another butterfly, and this one filled for $2.40. And now I just want to show you, had we not exited, what the profit would have looked like. So I still, again, got in right around here, filled the butterfly for $2.40. And in the real trading day, we exited sometime over here because we were anticipating this volatile spike up and we didn't want this leg right here to get challenged. So we ended up exiting, taking a decent profit, but this is what it would have looked like had we not exited, and we would have just let the butterfly expire worthless. So the market just ended on this on-demand feature. It's pre-buffering, so give it a second here, and then we'll go back and look at the monitor tab to look at what the P&L looks like. Okay, so now it's caught up. I think, okay, the market is closed here. We closed at 31.94 or something. Let's go back here. 31.93 is where we closed at. And so we simply kept the original credit that we filled for. So that's how that looks. Hey everyone, so I hope that helped you understand the strategy a little bit more. I've watched a lot of YouTube videos over this, and I have not seen anyone use it on a same day expiration strategy or even a 1 day till expiration strategy. So we found that in this current market, it seems to work well, and we have a longer window to exit with a profit than we do the vertical spreads. And we seem to have been able to capture a better premium for a little bit less capital than our typical vertical credit spreads. Also, I did not go over what a stop loss should be. So a good rule of thumb to stop out of this trade would be when the underlying reaches your break-even price. So thank you for watching. If you have any questions, please comment down below, or if you're a member of our room, please feel free to direct message me anytime. We're happy to feed you trades all day long, but it's really important to us that you understand the strategy and understand the methodology so that you can look to enter trades on your own as well, and hopefully with other tickers. So thanks again for watching.